Hello everyone, welcome to my YouTube channel. In today's video, I'm going to be showing the practical illustration of the double entry system. Like we can see on the board, this is an illustration. We have B and Sons Enterprise started business and carried out the following transactions in the month of January 2024. We have the first transaction: commence business and open an account at BICEC. He deposited the sum of 1,500,000 CFA francs and kept 500,000 CFA in the office for business use. So this is a transaction that has already been identified and recorded. So we need to classify and analyze this transaction. Doing that, we need to follow the double entry system. We have to debit assets when they are increasing and credit assets when they are decreasing. Debit liabilities when they are decreasing and credit liability when they are increasing. The same goes to capital. We are supposed to debit capital when it's decreasing and crediting when it's increasing. So here we have to first of all identify the accounts concerned. Here in this transaction, you will discover that you have the capital account because Mr. B and Sons started the business they just started the business. So starting the business, what they started the business with was capital. And they deposited 1,500,000 in the bank. So we have capital, we have bank. Also, on that same date, they had 500,000 kept in the office for business use. That means that 500,000 was kept in the till. So we have identified three accounts: the capital account, the cash in hand, and the cash at bank. So the first thing we have to do is to draw the T account for capital, cash at bank, and cash in hand. Alright, you see that we have three accounts: the capital account, the cash at bank, and the cash in hand. Because this enterprise they just started the business. They have set up a business. Of course, it's a sole trader that has set up business and has started an enterprise with it. So they started. So you see that the proprietor kept was 1,500,000 and 500,000. So with this amount, that's 1,500,000 and 500,000, he decided to keep 1,500,000 francs at the bank and kept now 500,000 in the safe. In case he needs money, he will not need to go to the bank and pay transport, pay for charges. So that is why he kept 500,000 francs in the safe. So you discover that there are three accounts. Remember, the double entry principle states that in each given transaction, there must be at least two accounts, one must be debited and the other credited. That means the debit should be equal to the credit. That is, the sources of funds should be equal to the uses of funds. Now, the source of fund was capital. Then the uses of fund was cash in hand and cash at bank. We need to analyze the accounts. We know that capital account here is giving. Capital account is giving to cash in hand and cash at bank, which means without capital, if there was not save up, if the businessman has not saved up the capital, there will be no cash in hand and cash at bank. So we debit the receiver and credit the giver, which means here we are going to start by crediting the capital's account. That's on the 2nd of January. We start with the bank. We put here bank. That is the description. Then amount was 1,500,000. Sorry, my board is so small. Then we go to the bank. 1,500,000. We go to the bank and debit the bank on the 2nd of January. We have here capital with the same 1,500,000. That's the first step. You see that the capital is equal to the the transaction, we still have cash, and it is still part of the capital. So we go here, we still put the same on the second, which is in January. We put here cash, which is cash in hand, 500,000. Then we go to cash as well. Debit on the second. We put capital with the same 500,000. So you will see here that if you add this 1,500,000 to 500,000, you have 2 million. And if you add 1,500,000 on the debit side, you have the same 2 million. We are finished with the first transaction. We are going to go to the next transaction, which was on the 3rd. We have bought equipment by bank check, 600,000 CFA francs. The first thing, we need to identify the accounts concerned. In identifying the accounts concerned, you see that we have equipment. Equipment is a fixed asset. So when there is any acquisition of a fixed asset, you create an account for that fixed asset, and then the means of payment, which was by bank check. So we have here equipment and cash at bank. So since we have equipment and cash at bank, we are supposed to go to the cash at bank and we record. But here, we cannot create a different cash at bank. We are supposed to go into the cash at bank and record, and we create a different account for office equipment. Here we have equipment and cash at bank. All of these two accounts, they are asset account. One is fixed asset and the other is current asset. All of them, they have one row. You debit asset when it is increasing, and you credit asset when it's decreasing. You see that office equipment is increasing in the establishment. There was 0 equipment. So now they have taken the cash at bank to buy office equipment. So there is an increase in office equipment while there's a decrease in the cash at bank. They have actually removed money from the cash at bank to buy the office equipment. So the first thing is to do, since we know that bank is decreasing, we are supposed to credit bank. We are supposed to credit bank because bank is decreasing. So we write the date here. We put here equipment. That's the description, the corresponding entry account. Equipment with 600,000. And we also create an account for equipment. We put here, the date was on the 3rd. This is it, on the 3rd of January. We put here bank. And we put 600,000. This is to show that if you go to the bank account, you will see on the debit side, you will see the date, the narration which will be, you will see on the credit side, the date, the narration which will be equipment, and you see this same amount, 600,000. The reason why we put the date and the corresponding entry account, which is the description, is for clear checking. In case the accountant commits an error, it will be easier for the accountant to identify what went wrong using the date and the description. If in case we are just putting the amount, that is not right, because we will call it the naked account, because you cannot identify anything that is happening if there is an error. The next transaction, purchase goods on credit from GOM, 200,000 CFA francs. So we need to identify the account concerned. So here you discover that we have purchases of goods and GOM. We have to ask ourselves, who is GOM to the business? GOM is a supplier, because the person that goods are bought from is the supplier, the person supplying the goods. So we call that person the supplier. But now we are not going to create the general accounts for the supplier, because in days to come, we may still buy from another supplier on credit. So we need to write create their independent account, so that at the end of the period, we will now bring them to one account. That's one creditor's account. So we need to create an account for NDONG, and then create an account for purchases of goods. Account for purchases of goods and NDONG. What I often do is that I advise the students to know who NDONG is. I will advise them to put their creditor on NDONG, so that they will be able to master that this NDONG like that is a creditor. Because in case you may be having NDONG also. So if you are having NDONG, you put creditor. NDONG may be a creditor and then NDONG a debtor. So it will be good to put the creditor on NDONG, so that you will remember when you are sending into the creditor's account. Purchases of goods and creditor NDONG. Remember, if these purchases of goods were done on cash basis, we will not create NDONG, we will not reckon NDONG. So the NDONG is coming into the accounts because NDONG sold to us. That is, the enterprise bought goods from NDONG, and BICEC and Sons promised to pay later. That is why they are recording NDONG, so that they will know that they are owing NDONG. So remember, I forgot at the start. We have the debit side and the credit side. The debit side represents the left-hand side, while the credit side represents the right-hand side. So when you are debiting, it simply means cut. So here you see that we have purchases of goods and the creditor NDONG. Let's use the golden rule, which says that expenses are supposed to be debited. So if we are using that golden rule, we know that purchases of goods is an expenditure. In fact, that's the main expenditure of the business. So we are supposed to debit that account. So if we can identify that purchases of goods is supposed to be debited, automatically creditor NDONG will be credited. So let's also look it from this other golden rule, which states that you debit a personal account when it is receiving, and you credit it when it is giving. So we have goods bought from NDONG. You see that NDONG is giving. So we are supposed to credit the giver and debit the receiver. So automatically, purchase of goods will be debited if we know that this NDONG is giving and we credit it. Automatically, purchases of goods will be credited. So we've done like this. We have NDONG 200,000, and we have the same here. Purchases. Since my space is small, I will write just purchase 200,000. So you see, you debit and you credit. Then the last transaction is sold goods on credit to C 400,000 CFA francs. So the first thing to do is to identify the account concerned. So you will see here that we have sales of goods and the customer. But here we will not create a general account for the customer. We are going to create an account for C. Now we have here sales of goods. And we have C. So you can equally also put here debtor C or customer C, so that you'll be able to know that this C here is a customer. So let's use the golden rule, beginning with C, which is a customer. It's a personal account. We debit the personal account when it's receiving and credit it when it's giving. So you see that C is the customer, the one buying the goods. So the customer is receiving from the enterprise. So we debit the personal account when it is receiving. So we are going to debit C, which is the customer, and automatically sales of goods will be credited. Then if we also use the golden rule, which says that all the revenues are debited, you see that sales of goods is a revenue, the main revenue of an enterprise is supposed to be credited, and automatically the customer account is supposed to be debited. So we have here on the 5th of January, we have C amount 400,000, And we go to the debit side of the sales account and we put January, we put sales. That's sales of goods. 400,000. Alright, if you look at it, you see that if we are to present the trial balance, which is to show the arithmetic accuracy of these transactions, the trial balance is going to be equal. But we are not supposed to draw the trial balance without balancing the accounts up. I'm not going to balance here because the accounts, you see that they just have single records. We need an account, for instance, something like the capital account that has 2 accounts or the bank, so that you will see how to balance off an account. In my next video, maybe the subsequent videos that will be coming up, I will show you how to balance an account, and I will then further show how to carry the balance to the trial balance. Thank you for watching. Please don't forget to like, share, and comment. And you have any question or anything you've seen that is not really making sense, please don't forget to mention in the comment section. Thank you.